Good morning, everyone. My name is Letshego Rankin. I'm the Executive Head of Institutional Distribution, and I'd like to welcome you to another exciting edition of our Moments with Investment Gurus, where we give you an update from some of our asset management teams. We like to use this as an opportunity for you to get the benefit of our insights on the markets, how we think about the opportunity set, and how we're positioning our portfolios. This has no doubt been an interesting year, and with a lot of news flow and uncertainty in the market. It is therefore important for us to share with you, our clients, how we navigate these challenges, and for you to be able to hear directly from our experts what their views are going forward. So today we've got Sanisha Pakrisamy, who will start giving you an update on the market and how we see the macroeconomic context changing. We then will have Ian Scott, who will give you his views on the fixed interest market and our positioning going forward. Wayne Dennehy and his team has had a phenomenal top quartile performance run over the last 3 years, and we hope that you will get some good insight in how their smart beta portfolios have delivered well in these tough markets. Then lastly, we have Rian Smith from our alternatives team, who has a proud track record of private equity funds, who will give you an update on how the opportunities are unfolding in this space. We are proud to share with you our first edition of the Momentum Investment Stewardship Report. We take the stewardship role that our investors have entrusted us with to heart, and we want to, as custodians of your capital, to assure you that we are honored and humbled by this responsibility. So we therefore welcome you to sit back and listen to our gurus and enjoy the morning. We look forward to interacting with you again in future. Thank you.
Hi, I'm Sanisha from Momentum Investments, and today we'll take a look at the economic rebound and how sustainable this is in this post-COVID-19 pandemic. We know that government-imposed lockdown restrictions had reached their most crushing point on the global economy around the middle of April this year. Since then, however, we have started to see economies beginning to recover as the restrictions on economic activity, as well as the movement of people, were starting to lift. We're now entering an environment where we are starting to grow out of the virus slump. Economies globally have since staged quite a strong recovery into the second quarter of the year. Nonetheless, we've seen that the momentum behind the strength of this economic recovery has begun to wane. We know that businesses are now forced to operate with non-pharmaceutical interventions in place. So this means extra social distancing measures, extra hygiene measures, which come at a cost, while consumers have remained very nervous about being infected in more crowded areas, particularly as some of these economies have already started to see a second wave in infections. This time around, however, these infections have been coupled with a much lower rate of fatality, as well as a much lower rate of hospitalization. Nevertheless, these ongoing fears have left more empty tables at restaurants, more empty seats on scheduled flights and at cinemas, and this, of course, has had negative implications for growth. We talk about the 90% economy. Now, The Economist publication has referred to this phenomenon as the 90% economy, where the global economy is now expected to only operate at 9/10 of its capacity. This variation in economic performance has actually been quite striking. So if we look at trade and industry, for example, these sectors actually bounced back relatively quickly. Whereas if we look at services and consumption activity, these areas of the economy remain well below pre-pandemic levels, as consumers have continued to shy away from these crowded areas in fear of catching COVID-19 in the second wave. In our view, this change in consumer behavior has actually come about in spite of how governments have dealt with these lockdown measures. So let's take Sweden as an example, where restaurant activity actually fell by a similar margin relative to other neighboring countries that had imposed far more stringent forms of lockdown, such as the Netherlands or Finland. So in our view, the shift in consumer behavior may actually remain the case for much longer unless we actually get a viable vaccine that can be widely and cheaply distributed across the globe. We're also quite worried about bankruptcies and elevated levels of unemployment. Both of these factors can weigh further on the economic recovery that we are projecting going forward. We know that businesses have deployed far less capital in an uncertain environment. We know that consumers have also spent less in an environment where they fear going out to crowded places. As a result, government has now had to step in to save the economic recovery. This unfortunately comes at a price. Governments are now falling further and further into debt, and we know that they were already sitting on very large levels of debt even going into the COVID-19 pandemic. And this, as a result, is going to lead to a further migration lower in the average sovereign rating across the globe. We've also seen that many central banks have been forced to absorb this additional issuance. And as a result, 3 new concerns have come about. Firstly, unconstrained government spending. What will stop governments from spending in an environment where central banks are there to mop up the additional issuance? Secondly, we're also quite worried about central bank vulnerability to political interference, which wasn't the case for many years in a row. And thirdly, we are worried about the greater inflationary bias that may emerge further down the line, even in an environment where deflationary forces are playing out, such as aging populations which have caused that, or the advancement of technology. We've entered this environment of a new world disorder. Poorer nations have been far less able to deploy the same scale of financial support during the COVID-19 pandemic than their developed market counterparts. And this really suggests that that wealth and income gap between these economies in emerging markets and between emerging markets and the richer nations are just likely to expand in the next couple of years. A breakdown in the global assembly line has also come about in the COVID-19 pandemic, and this has really caused globalization trends to unravel even further. This, in our view, will continue to harm the prospects of emerging markets in particular, and largely just exacerbate those socio-political aftershocks of the COVID-19 pandemic. Interestingly, we've also seen that within developed markets, these habits of global cooperation that have been built up over a number of decades have started to disintegrate. We know that America was pivotal in rebuilding the global order after devastating events like World War I or even World War II. However, the outcome this time around will really depend on a more internationally minded presidency. We can also talk of this geopolitical creative destruction that's currently taking place, and this is likely to keep global uncertainty reasonably elevated, which, if we look at the past, will have very negative consequences for longer-term growth in the global economy. Thank you for your time.
Hi. My name is Ian Scott. I head up the fixed income investment team in Momentum Investments. And today we're going to talk about credit. Why is credit important? Think about it. Every investment that you make that is not exposed to the South African government is credit related. If you put money on call with Absa tonight, you are taking an interest rate decision and you are taking a credit decision. And that's why the theme today is credit mining. And why is it important? Because I think for investors, it's quite important to understand that looking for good quality credit is like mining. We literally have to mine through tons and tons of credit names before we find that 1 or 2 jewels. So let's have a look at what that credit market in South Africa looks like. It's a very sizable market. It's about 1 trillion rand, over 1 trillion rand at the moment. And every year there's about 150 billion rands worth of listed rated credit issued in the South African market. What we saw in 2019 was literally a bumper year, 170 billion rands worth of credit that was issued. So a lot of confidence in the system that corporates, SOEs can actually issue credit in the South African market. What has actually happened is COVID happened. And what are we seeing? That yes, this year, we are only getting about 50 billion of issuance so far, and we think at a push, we'll get about 105 billion of issuance this year. So basically half of last year. But a good sign is that there are corporates and banks in South Africa that feel confident enough to actually issue debt in the South African market. What has happened to the price of credit? Quite important if we looked at fixed rate credit. These are fixed rate bonds. The coupons don't fluctuate. What we've actually seen is there's been a good demand for fixed rate credit in South Africa. Why? Because bonds in South Africa is such a cheap asset class. The yields are very high above inflation. They look attractive. What we've seen is the converse in the floating rate credit market. Now, these are the shorter dated credits that banks and corporates and industrial companies issue into South Africa that trade over JIBAR, typically in the 1 to 3 year area. What we've seen is because of the credit quality that's deteriorating, balance sheets are in trouble in South Africa due to COVID. There's a higher price that needs to be paid by corporates to borrow money. And we've obviously seen a big move up in industrial spreads and obviously state-owned enterprises as well. The market is charging a higher price for taking on the credit risk of South African corporates. So what does it look like in terms of the globe? Because we always live in our South African bubbles, but what does it actually say for South African corporates? So our South African corporates traditionally are in a good quality state, strong balance sheets. But what's happened? The credit quality is deteriorating. When you look at the graph, and it's upward sloping, you can see the credit quality is deteriorating. Are we surprised? No, because the South African economy is in a recession. Companies are not making big profits. There are costs. That's why the balance sheets are under stress. And in relation to our UK counterparts and our US counterparts, South African corporates are under severe credit stress. If we move a little bit over to the South African banking sector, you would say, well, the South African banks are strong, and we know they are strong, and we'll look at them a little bit later on into detail. But you can see over the last while, their credit metrics are also deteriorating. Why? Because there's less people paying their loans and their mortgages to banks, right? So banks are feeling stress in relation to the US and UK counterparts, where their central banks are bailing out or helping the banks, right? In South Africa, we've only seen limited support from the SARB to the South African banking system. So what is happening with governments? Now, this is the obvious one, because we obviously read every day about poor government finances, fiscal issues. Are we surprised that the quality of government is deteriorating? We see that the Minister of Finance in the budget set, there's an active scenario and a passive scenario, and our debt to GDP could be over 100%. That means higher credit risk, higher spreads, higher yields. Are we then surprised when we see that our bond yields on a real basis, meaning after inflation, is the highest in the world? Because it reflects bad government finances. It reflects Eskom. It reflects bad SOEs. The market is asking for a higher credit spread than when it used to be years ago, when the budget was better. But that does not mean that the risks are not priced. That does not mean that there's not opportunities in the government market. State-owned enterprises, oh my word. Let's not talk about Eskom, but yes, Eskom is reflected in this graph. We're obviously seeing a lot of pain in the sector. We know that a lot of our peers are saying they're not willing to lend to SOEs anymore. But is that the right investment decision? Is that the right way to do? We think not. We do think that there are opportunities in this market. Yes, Landbank defaulted in April. We know about this. We know that Denel, Post Office, they're all asking for government bailouts. But that does not mean that there's not opportunities. Remember, there's 700 SOEs in South Africa. Maybe there's a 1% or 0.5% of SOEs that's not bad. And that's the mining and credit for us to find that 6 or 7 out of 700 SOEs in South Africa, that's okay. Their balance sheets are okay. They're actually making money. It's not an all fall down situation. I think one of the biggest risks that we have is that people like to draw lines in the sand. All SOEs are bad. All corporates are bad. We don't necessarily believe that. We say, well, we think there's 1 or 2 gems in the sector, and we have to go and look and find. That's the mining and credit, finding the gems between all the other rocks. And as we know, there's 700 rocks, and maybe 4 or 5 of them are worth an investment. So we look at banks and we say, well, sure, South Africa banks are in good quality. They're in good standing. They carry about 14 or 15% of capital. That's a lot if you think the global average is about 8%. And we say, well, even banks are showing a deteriorating quality in credit. Why? Because of the non-performing loans. Joe Soap out there is not paying his bond, or is not paying his car loan or his credit card. And yes, that's why there's a deteriorating quality in our banks. But if we look globally and we look from 10,000 feet up, the South African banking system is still very solid. It's not going to default soon, but it will have a bit of balance sheet stress. But we think in credit, this is probably the best space to hide. The South African banks are still of very high quality. In all the ratings reports, it's one of the strengths of South Africa. Even Moody's will say to you, the South African banking system is of high quality. If we look for corporates, probably less so. But once again, let's not draw that line through the sand and say all South African corporates are bad. That's not true. Yes, there's probably sectors in South Africa that's under severe stress. Think about construction, think about the tourism sector, think about the hospitality sector. We obviously want to avoid those areas. But that does not mean that in areas like industrials or the healthcare sector or the retail sector, there might be very interesting opportunities in mining for these gems in South Africa. And we are finding opportunities. We just have to mine through a lot of rocks in sectors that is not great at the moment. But it says to us, corporate South Africa is probably okay, given all the interactions that we've had with a lot of management teams over the last 6 months since COVID. I can promise you a lot of management teams are shoring up the balance sheets. They're taking the correct actions to protect our investments in them. Sure, there's always the fallout management teams that will not do the right things. And it's quite interesting that in this post-COVID time, how management teams distinct themselves from the poor ones. And it really is a distinction between good and management teams when it comes to credit. Yes, real estate, tough one. We know and we see the numbers and we hear about the empty offices and the empty shopping centers. Are we then surprised why this graph is spiking the way it has? We know that work from home will have a material impact on the office sector. Online shopping will now have a material impact on retailers. Yes, we are very concerned around the REITs, their distributions, the strength of their balance sheets. We actually took a decision a while ago that in days gone past, we always were very happy to give unsecured loans to the sector, and we've changed our view. We say, well, we want to partner other financial institutions in lending to REITs, but on a secured basis. We want to have security, we want to have a piece of that shopping center or that office as security against our loans, because there's more pain probably in the sector to come. It's already repriced significantly, but we think it will take a while for the sector to recover. Ooh, and a favorite, Landbank. So yes, as I said, they defaulted around April and the market reacted severely. If you look at the graph, Landbank used to be able to borrow 3-year loans at around 150 basis points over interbank rates, and that shot up to over 1,000 points over interbank rates. Remember, when spreads go up, prices go down, so obviously there was a big capital drawdown on Landbank paper. We are part of that process. Yes, we do have Landbank exposure, but I think what's quite important is what we are seeing in the market is that the markets are taking comfort from this debt restructuring from Landbank, because you can see the spreads moving from those very highs over 1,000 basis points to around 800, which says, well, I think the market is starting to price that there's going to be some sort of decent workout or debt restructuring for Landbank. As I said, we're part of that process. It takes a long time. We have to deal with National Treasury. We have to deal with Landbank. We have to deal with the banks and the financial advisors. But it's quite important to understand that a few key things have happened in Landbank, that they've had a 3 billion government injection. We are receiving all our arrears coupons. And hopefully soon the financial statements will be published and authorized by Parliament. And a new liability solution will hopefully be presented in the next few months, which means Landbank can actually go forward and be a bank. Why is Landbank important? Remember, one big difference, for example, between Landbank and Denel. Landbank is systemically important. It carries 30% of the loans in South Africa of the agricultural sector. systemically important, and now not so much. So we think we just have to stick it out. We still believe that investors will not lose money in Landbank, but we have to throw a little bit of time into this to make it work. So just to wrap it up, we think there's good opportunities in credit, but we have to be a lot more circumspect. We think that there's a few gems that we will have to hunt for. It's hard work, but that's why we're here for our clients. And I believe in the fullness of time, clients will reap the benefit of the mining that we're doing for them in this sector. Thank you.
Good morning, ladies and gentlemen. My name is Wayne Dennehy, and I'm part of the Momentum investment team. And I have the next 15 minutes to share with you some of the themes, some of the stories that we're seeing both from a global equity perspective and that we're seeing in the South African equity market. But before I get started, I think it's always useful just to get a bit of perspective in terms of what the opportunity set looks like for SA investors in the last 12 months. What I'm showing on the graph here, if you focus first of all on the grey graphs in the middle of the picture, we're showing there, had you been invested in South African financials or South African industrials, you would have had a minus 30% return for the last 12 months. Had you been in South African resources, you would have been up around 30% for the last 12 months. Fixed income bonds, inflation bonds, pretty flat, and cash, a small positive return. Focusing next in red, if we look at our various precious metals, clearly whenever there's a scare in the market or when the market gets nervous, gold really shines, excuse the pun. And gold is up nearly 30% for the last 12 months. And my word, I remember at the beginning of COVID what happened with oil. The futures price of oil went negative. I mean, how can that possibly happen? And oil down around 30%, or in fact 23% for the last 12 months. If we then look offshore, focusing on the far right first, you see that the rand is actually down around 11 to 12% for the last 12 months. And in the various offshore equity markets, we've seen that if you were in a sort of in the various like emerging markets, you're up around 11, 12% for the last 12 months. And if you were in the US stock market, up close to 20%. But had you been in the UK stock market, you're actually down 15% for the last 12 months after factoring in what happened with the rand. A truly phenomenal story, and possibly leading to some of the widest divergences that I've certainly seen in recent times. If we look at the next slide, what I'm showing here, there's really 2 points that I'd like to actually pick up on. First of all is that looking over different time horizons, year to date, 1 year, and 3 years at the SA equity market in various forms, you've had a negative return in SA equities for the last 3 years. That is quite phenomenal. So if you bought the market 3 years ago, a negative return for the last 3 years, that's incredible. The second message is that what these two graphs represent is the red bars effectively is if you bought a particular equity fund, but you've capped your exposure to no share being more than 10% of the market. So it's your capped SWIX type of exposure. And the blue lines effectively showing you if it's uncapped, you just buy the market as it is. And the difference in returns is phenomenal. And you can see even in the 3-year space, over 3 years, you've done roughly 5% per annum worse in a normal equity fund that has not been capped. That's incredible. Personally, I actually prefer a capped SWIX or a capped equity fund because it actually gives less risk. You're taking a less concentrated risk in some of your larger equity shares. But in the last 3 years, we've seen a wide divergence in fund returns between those two benchmarks. And it's very important for you as a client. If you're comparing equity managers with one another, make sure that you understand what their equity benchmark actually was, because they might have significantly outperformed purely because of their benchmark, not necessarily because of skill, or vice versa. I think let's start from a global equity perspective, and then we'll circle back to what we've seen in our local markets. On a global basis, we're showing here what the US stock market did in the beginning part of the year, so the S&P 500. And you can see it was bouncing along quite flat, nothing too exciting. But it was what happened in February and into the middle part of March was severe. And we often think back, well, was it worse than what we saw in 2008? It was far worse. And this graph tells that picture really nicely. If you compare it to 2008, it was towards the end of August 2008 that Lehman's went bankrupt. Had the market unfolded in a similar way to what we saw in 2008, the equity market would have had to get to roughly where that blue line is by the end of August. We got there in just under or just over 30 days. Unbelievable how fast the market fell, falling more than 36% in roughly 30 days. And standing at the end of March, it really was a scary place for investors. The magnitude and the speed of change was completely unprecedented. Interestingly, though, is that what we saw in terms of how the market recovered and what happened into COVID is that it really was a case of it wasn't a falling tide and then a rising tide. Things actually played out quite differently. So what we're showing here, if you look at the blue line at the top, it's the pharma stocks. It's the top 5 stocks, the 5 biggest shares in the US market. So it's Facebook, Amazon, Alphabet, which was Google, Microsoft, and Apple. Had you bought just those top 5 shares on the 1st of January, you would have shown a little dip, but you'd now be up around 40% for the year to date. If you bought the next 5 biggest shares, you still haven't made your money back. You bought the next 45, you still haven't made your money back. The next 400, you still haven't made your money back. So there's been a strong divergence in how funds have performed depending on how they were invested in this particular case in the US equity market. This slide is the same story, just shown a little bit differently. So what we're looking at here is we're trying to understand what percentage of the market does the top 5 shares constitute. And you can see typically during the 90s, it constitutes roughly around about 12, 13% of market, those top 5 shares. Into the 2000 crash, it peaked at around 17, 18%. And you can see now those top 5 shares, Facebook, Amazon, Alphabet, Microsoft, and Apple, sitting at around 24% of the market. It's unprecedented. Interesting as well, the US tech sector is now around 9.3 trillion US dollars. To put it in some sort of perspective, the US tech stocks are now worth more than the entire European stock market. That is significant. Clearly, US tech stocks have been the place to be. Looking forward, only time will tell. So to summarize what's happened offshore, you can see that yes, there have been positive returns. Largely a story, though, of the rand weakening, and very much a case for you as individual investors, where was your fund manager? If they were in the UK, you've had a torrid time. If you've been in the global emerging or your more sophisticated markets, you've typically seen a return of somewhere between 12 and 20% from your offshore market. Let's circle back to what we see locally. And this is a very nice slide to look at in terms of that we often have a look at in terms of how are the active equity managers performing in South Africa relative to a benchmark or relative to their particular index fund. And what we're showing here in the blue lines is if the blue line is below the horizontal axis, the average equity manager is underperforming their benchmark or underperforming a normal tracker fund. If the blue lines are above the horizontal, they are outperforming their benchmark or outperforming a normal market index fund. And you can see pretty much for the last 2 years, managers have been significantly outperforming those particular benchmarks on a market average basis. But now, for the first time in nearly 2 years, active equity managers are really struggling to beat that market benchmark. In the property space, a very similar story. And we know how tough it's been in the SA-listed property. That market sector was down roughly 45% at some point. And you can see for the last 2 years, active managers are struggling to beat the SA property index. They're struggling to beat a passive benchmark. It's not an easy space to add value, and it's a place in the market where we've seen a massive, massive reset in value. What I'm showing here effectively is the top 40 graph, a sort of time series of how the SA equity market has been performing. And you can see it was pretty much bumping along for most of last year and into this year. And then you can see what happened in February, March. We're down nearly 30% in absolutely no time. And I often get asked, Wayne, what is this concept of a V-shaped recovery? What does a V-shaped recovery mean? And to be honest with you, if you look at the next slide, I don't think I've seen a better picture of a V-shaped recovery in any textbook. This is your classic V-shaped recovery. The market crashed into February, March, and you can see pretty much standing at the end of March, if that offered you, listen, you're down 30%, 35% on your SA equities. If I'd offered you, you can have your money back by the end of August, I think we all would have taken that bet. And that's exactly what happened. You can see the market rose up, and we've now basically fully recovered on a year-to-date basis. The point, though, as I'm going to show you, is this is for the market as a whole. If you just bought the market with no caps on any of your holdings. The challenge is that we haven't seen a symmetrical market recovery, and the experience to you, our clients, has probably been very different depending on where you've been. Let me explain to you why. What you're looking at here is a time series of, in the SA market, in blue, how has the SA financial stocks performed? And you can see clearly financial stocks have been under massive pressure. Banks, insurance companies, COVID has really hit them really hard. And you can see if you were in a SA financials fund, you are significantly down, and you're still down. You haven't made back anything that you've lost yet in the sort of COVID crisis. Had you been in the SA industrials, shown in green, you're pretty flat now. You pretty much made your sort of money back, but it's largely a story around Naspers and Prosus. Those two shares have dominated. And the red line, had you bought SA resources, you're up 20% since the start of the year. What a great story. Absolutely unbelievable. And in fact, as we stand today, Anglo Gold is one of the top 5 shares in South Africa. I don't know when last I saw a gold share as one of our top 5 shares. But you can see from this graph, your experience in the SA equity markets, number one, will be very different depending on what your fund manager was actually tracking. Was it SWIX or was it the uncapped SWIX? And secondly, where were they? And you're going to get a massive spread in terms of fund returns if you look through time. So what do you need? What do you need to actually navigate through these really challenging market times? How do you put the best solutions together? How do you make the most out of it? And this is how we as an investment team think about building out our equity building block. This is what we consider. You need different ingredients in that particular equity fund. You need styles, so you need value, you need trending, and you need quality. You need different styles in that equity construct to have a fund that's more robust through different market cycles. Then we as a strong investment team, we believe in actually bringing together different managers as part of how we actually build portfolios. So we believe bringing different managers now to manage each of those styles and what we actually need in our funds. And finally, thankfully, the market's moved on from where we were several years ago, where it's no longer a conversation around is it active or is it passive? It's now all about how do we bring that all together to build portfolios that are right for our clients. And how you access this is in the retail space, be it on our wealth platform or in our unit trust manco. We have the Momentum Equity Fund, which is a more active construct of this type of thinking. Or we have the Momentum Core Equity Fund, which is a more passive construct of this type of thinking. In the institutional space, we have the Momentum Classic Equity Fund, exactly the same, this sort of thinking, but in a more active way, and the Momentum Target Equity Fund, a more passive construct of this type of thinking. And finally, and I certainly don't expect you to read all the entries here, it's more to get a graphical picture of what the market looks like. What I'm showing here is the institutional funds, what that range of fund returns looks like from the best manager on a 3-year return basis to the worst manager on a 3-year return basis. And you can see there's a wide spread of returns. And retail is a little different, but in the retail equity space, to show you how those market returns have just blown up. On a 3-year basis, that range of returns between the best equity manager in the market and the worst equity manager in the market was roughly 22%. So if you bought the best guy or I bought the worst guy, I would have done 22% per annum different between that worst and best. In the last 9 months, because of all the stories I've been showing you and the themes I've been showing you, that spread is now 45%. The best manager versus the worst manager is a 45% difference in your experience just for the last 9 months. In our institutional space, those 2 red arrows you can see there, that's our 2 institutional equity portfolios, our more active version and our more passive version on a 3-year basis with a commendable story. Just outside top quartile and strongly into second quartile on a 3-year basis, something we're very proud of. These have certainly been interesting times for SA investors in the equity space. White knuckles at times. But we're very proud of how our particular portfolios have held up through these unique and challenging market conditions. For us, it's really a big thank you. Thank you to you, our clients, for staying invested and for trusting Momentum Investments with your savings. Thank you.
Good morning. I am Rian Smit, Portfolio Manager, Private Equity at Momentum Investment. Today we are going to talk about private equity and why we believe it is closer to the real economy. The private equity universe and the South African context. Before we dive into the private equity market and its part in the wider economy, this photo represents a good metaphor of the opportunity set. The universe is huge, with many galaxies and stars, many of which are large and well-known, and others much smaller and not as well-known. There are even a greater number of stars that we don't even know about as yet. Before we analyze this opportunity set, it is probably opportune that we first recap what private equity is. As the name implies, it is essentially equity investments or ownership of private companies. These companies are not typically listed. They are not bought and sold on a regular basis. In most cases, the investment is over a long-term horizon, 5 to 7 years, and therefore it is considered patient capital. These private equity investments are typically made by private equity investors, such as private equity firms or financial institutions. The private equity fund manager, together with a management team, will acquire control of a business in order to execute on an agreed-upon investment strategy to grow and transform the business over a long-term horizon. Whilst private equity is not as well known or widely invested as public equity markets or global stock markets, it is globally a well-known and well-developed asset class, which has produced excellent returns for long-term investors for decades past. Globally, the private equity industry is estimated to have about $4 trillion under management. The South African private equity market context. To get an idea of the South African investable universe or the opportunity set, we can simply use the South African Revenue Service tax statistics for 2019. There were approximately 900,000 companies that were expected to file tax returns. Of these, 380 are large companies with taxable income of 200 million rand or more. Conversely, there were approximately 160,000 small business corporations, which are not typically the target for private equity fund investors. This leaves, in theory at least, approximately 760,000 companies that could be investable by private equity funds. However, many of these are special purpose vehicles, individual holding companies, and as such, the actual investable universe we consider to be closer to 10,000 companies. The private equity assets under management and the South African context. As we can see here, the South African Private Equity and Venture Capital Association, or SAVCA, is the industry body for private equity. According to SAVCA, the private equity industry had approximately 184 billion rand in assets under management in 2019. Private equity firms raised 21 billion rand in new commitments from institutional investors for these funds. These private equity firms made 588 new investments in 2019, worth approximately 25 billion rand. Most private equity funds in South Africa are considered generalist funds that are not limited to any specific sector. General private equity funds are an important source of funding for growth capital, expansion capital, financial restructuring, startup ventures, early stage ventures, replacement capital, or management buyouts of both public entities or private entities. Infrastructure funds have also seen increased popularity, especially with institutional investors, having funded numerous projects such as toll roads, renewable energy projects, affordable housing, student accommodation. Whilst private equity funding is essential, private equity managers also bring a unique skill set to enhance the value of the businesses. These could include enhancing the governance of these privately held companies, family businesses, the skill set and resources to enhance the operational efficiencies of these businesses, and also to bring new access to new markets and other geographies and other product lines to these companies. If we consider the private equity versus the listed companies, we can look at the Johannesburg Stock Exchange. The JSE has a combined market capitalization of 14 trillion rand. It's approximately $870 billion. This comprises 342 listed companies. Whilst private equity firms are making new investments, the JSE has had 71 delistings over the past decade. As we can see here, new listings raised about 35 billion rand on the JSE compared to the 25 billion invested by private equity firms. As we can also see here, the JSE is not replacing these delisted companies with new listings, and hence the growth in the private markets. If we look at the leading private equity-backed companies, some of these companies that are backed by private equity firms are the ones that we were directly or indirectly involved in. Many of these companies are household names, whilst others that are hugely successful have been flying under the radar, but still provides goods and services that we all use. Examples: Vox is a well-known internet service provider and a fiber to the home and fiber to the business provider as well. Prime Media is the leading broadcasting and advertising group with well-known brands such as 94.7, 702 Talk Radio, Cape Talk, KFM, and we all know Prime Media Outdoor with the billboards all along the highways and the main roads. Thai Auto is a leading tire and batteries dealer in Southern Africa with well-known brands such as Tiger Wheel and Tire and Tires and More. And who can forget Me Not Twin Saver, leading brand in tissue and toilet paper. Others are completely under the radar. Channel VAS, as a colleague of mine described, is probably the most successful fintech company that you've never heard about. It has a subscriber base of 750 million individual subscribers over more than 30 countries across Africa, Latin America, Middle East, and Asia. The company provides airtime credit services to prepaid customers. It advances, on average, $12 million every single day in airtime credit. The company uses unique big data analytics and machine learning to support low loss ratios. Other examples: Waco International. If you've driven past a construction site and see scaffolding, chances are that was supplied by Waco. Rhodes Food Group, if you know Bull Brand, you know Foods Group. And lastly, Much Asphalt. If you've driven on any of the highways in and around Johannesburg or Gauteng, you've driven on tarred roads made from tar from Much Asphalt. So why would we invest in private equity? Typically, as we have seen, there are opportunities that are not available in the listed markets, but we also have lower volatility and we can have outperformance. The reason for this lower volatility is that there is no frequent buying and selling of the shares, and the companies are held for a 5 to 8 year investment period versus short-term trading on the JSE. Furthermore, valuations of these private companies are typically performed on a quarterly basis. Valuations are driven by the actual earnings of these companies, rather than by the sentiment of fear or greed of the public markets. Excess liquidity in the public markets, fueled by quantitative easing by the central banks, which can lead to higher public market valuations. The annualized volatility of our private equity fund is approximately 2/3 of that of the all-share index. Most listed companies report their results and earnings on a semi-annual basis. A number of large international companies and mining companies might report on a quarterly basis. In contrast, the private equity funds report on a quarterly basis in arrears. These private equity valuations may consequently lag by up to a few months. In between these quarters, the valuations are typically kept constant and only adjusted for actual realizations or new investments. Private markets are consequently not subject to the vagaries of the listed markets, the euphoria or the fear, as we've seen of late. Having said that, the private markets cannot escape the actual economy. These valuations reflect what is really happening in the economy, on the ground, small businesses all across the country. It cannot escape these realities. COVID-19 related lockdown measures brought new realities. It saw a significant drop-off in demand from both consumers and businesses. Numerous industries and businesses were completely shut for months on end. Revenue and earnings consequently contracted significantly, for most companies at least. Others, such as essential services providers and technology companies, were more resilient and managed to grow their businesses. Whilst these public markets have rallied off the March lows, fueled by the COVID-19 fear and panic, central banks were quick to inject liquidity. Since then, the S&P has had the greatest rally of all time, both in terms of speed and magnitude. It reached its previous high in less than 4 months. This was, however, very concentrated, mostly by the FANGs: Facebook, Amazon, Apple, Netflix, Google, and Microsoft. As we can see, the South African indices also rallied strongly off the March lows, but have not yet reached the previous highs. Many economists, investors, analysts, and commentators have, however, raised concerns about the sustainability of the rebound, given that there was a contraction in the earnings. This is especially true should there be further rounds of lockdown implemented by governments across the globe. This leaves very little room for disappointment in growth or earnings. As these public markets have rallied off their lows, they have become more expensive. Global GDP is expected to contract by around 3% and then to rebound again by 3% forecast in 2021, although from a lower base. South African GDP is expected to contract by more than 7% in 2020, but only to rebound by about 2%. The so-called SA Inc. shares have massively underperformed the SA global shares, such as Naspers, Prosus, AB InBev. Even though markets have rallied strongly, these rallies are not necessarily underpinned by earnings. South African earnings per share is expected to contract by around 20%. The effect of this is that the price to earnings ratio of the all-share index have increased dramatically. This chart clearly shows the disconnect between the listed markets and what is really happening on the ground. We expect through all this that although South Africa faces unprecedented headwinds, we expect private equity to outperform over the very long term. This is driven by the vast opportunity set as compared to the listed markets. These opportunities are typically fairly priced. And lastly, also by applying the private equity managers' proven skill sets to enhance the value of the businesses they invest in. Therefore, they are expected to unlock the risk premia, such as liquidity risk, control premium, and complexity. In conclusion, this slide is a perfect metaphor for how one can look at the equity market. Like the ocean, the opportunity set is vast. The key learnings from today: the total economy is far wider than the listed markets. Numerous opportunities exist only in private markets. Private markets generally have lower volatility in their valuations. There is an opportunity to extract illiquidity premium by applying patient capital. And lastly, a relatively small allocation to private equity compared to public markets. With that, thank you.